Morning. As always, good speaking with you. But the markets have not been in very good health lately. I mean, 8,200 to 7,800 in the recent past. Do you expect further weakening of the market sentiment?
Hi Sonia, good morning. I don't think it should have come as a surprise, the fact that the market's settling into a slightly lowish kind of range. I think we discussed that last time too. I did say that it was difficult to get very bullish on the market given the kind of news flow that's come out over the last fortnight or so. I think the one good thing is that the market's made an attempt technically to somehow hold on to that 7,700 kind of levels, because coming out of the earnings season that it did, after the Bihar election results, global markets also being slightly wobbly, all of this could have easily led the Nifty down to a breach of that 7,500 low that we saw a few weeks back. That has not happened. And I think if you're clutching at positive straws this morning as a trader, you would have to take on board that fact that the market's at least trying to stabilize or consolidate in this 7,900 kind of zone. But the jury's out on whether we go back and retest those lows or take that out. I think for the near term, what's easier to say, Sonia, is that earlier, maybe 2 or 3 weeks back, it looked likely that the market might be able to, or the Nifty might be able to stabilize in an 8,000, 8,400 kind of a range. And I think that would have been one view taken by a lot of segments of the market. But post the last leg of this earnings season, the way some of the political and policy news panned out, and of course the global landscape, I think now we probably are shifting to a slightly lower kind of a trading range of, if you want to be optimistic, 7,700 to 8,100. I don't see the Nifty crossing 8,100 in the near term very successfully, because there are just too many headwinds and lack of positive news which should take the market higher from here. So I think the best case scenario for the market is that it spends more time in this 400 point kind of a range, 77 at the low, 8,000, 8,100 on the highs.
Udayan, hi, morning. Good to talk to you. I was talking to a big fund manager yesterday, and he said that the Nifty might be showing 7,800, but the broader market is, almost at 8,500, 8,600 kind of Nifty levels. And that is the way, to look at this market, to remain stock specific. Do you think that's going to continue over the next 3 or 6 months?
Well, I think there is sense in what he was saying, that this market is becoming a bottom-up market once again, because there is nothing right now to propel the market from a top-down perspective. 1 year back, there was so much talk about macro tailwinds for this market, earnings picking up, and therefore the Nifty successively going to new highs. But this is not that kind of market any longer, because you do not have too many positive triggers to drive the Nifty to new highs immediately. In the absence of that, what seems to be happening is that the Nifty is trying to play a holding kind of a game, that it's trying to restrict downsides and trying to become a slightly defensive kind of a market in that tone. So what the Nifty is almost saying is that I know that there are not too many upsides right now, but let's see if one can hold on to 75, 7,700 kind of levels and spend more time here consolidating, so that when the takeoff happens on the news flow, we can actually go back to that 9,000 level also. And while this kind of a holding pattern plays out, inevitably you see individual stocks being the place to be. The Bank Nifty or the Nifty, if you buy the Nifty ETF, chances are that you will underperform a portfolio of stock kind of approach. So yes, you're right in pointing out that individual stocks is the way to be out here. And you just look at individual sectors, you will get the same kind of feeling. I mean, I was just looking at infrastructure as a sector, and a lot of people will tell you that's a sector which is doing very badly. Indeed, L&T and Crompton Greaves are down 10% on the year. BHL is down 35%, Thermax is down 20%. But that's not the only story. You look outside that basket, Cummins is up 15%, Ashoka Buildcon is up 25%, J. Kumar Infra is up 35%. So if you have picked the right infrastructure stocks, and I chose infrastructure because it's a sector which is not a loved one right now, and people don't want to be there, and they cite the example of L&T and BHL. But so many mid-cap stocks, even MNC stocks, have done so well in a landscape where infra has not been one of the performing sectors. And I could say the same for so many sectors in the market, where you could get stocks which are down 40% and stocks which are up 40% year to date. There's just increasingly a very bottom-up market.
Hi, Udayan. If you had picked pharmaceutical stocks like a Dr. Reddy's, Sun Pharma, Lupin, you would have made a lot of money in the last many years. And you like categorizing pharmaceutical companies as landmines and gold mines. But what happens when gold mines like Dr. Reddy's, Sun Pharma starts correcting 15-20% just in a span of a few weeks?
I'm worried about this sector, Rima, frankly, because, this is the bluest of blue chip sectors along with high quality consumers. And the way Dr. Reddy's has tanked 25% from its recent peak, I think would have sent a shiver down the spine of the market, because this was almost like the holy cow in the market, pharmaceuticals. Market can go to 9,000, market can come down to 7,500, but pharmaceuticals as a space will be untouched by any kind of carnage. It had almost acquired that kind of invincible image, but I think that's been tarnished considerably, first by Sun Pharma, then by Dr. Reddy's, and you've seen some of the results like Lupin of late not being too great either. So I think pharmaceuticals is a difficult space right now. And what has happened more than individual corrections in stock prices is that pharmaceuticals, they get that rich kind of a valuation from the market because they build in a layer of management premium and they build in a layer of predictability premium. And now with this US FDA accidents happening one after the other, I think you would have to go back, and I'm asking myself whether pharmaceuticals deserve to trade at these kind of valuation multiples. In my eyes, or in my book, anything which can fall 25% in 2 weeks must have a big risk premium built into its valuation multiple. You cannot give a stock. This will not happen to Hindustan Unilever. It usually does not happen to an ITC, which is why they trade at 30, 35, 40 P multiples. But if you're telling me that a stock that you're paying 35 times to buy can lose 25% because of an event risk, then I think that needs to be priced into its valuation multiple. It cannot trade at those kind of lofty valuation multiples any longer. Look at the brokerage reports which are coming in now on some of the stocks that you mentioned. Somebody is saying Dr. Reddy's might have negative earnings growth in 2017. Can that stock hold 30 P multiple? So it's no wonder that the stock has shaved off 25% and come down to reasonable P multiples of 22, 23 right now. The same with Sun Pharma. So I think what might happen, what the market might now do, is to say, we will now re-evaluate pharmaceuticals as a sector. You may be bullish or bearish on Sun Pharma, that's a different call. But I think you will need to reassess whether those kind of valuation multiples are deserved by the sector. And I think pharmaceuticals is a sector you need to be a bit careful now, because I know it's done the best, as you said, in the last 4 or 5 years, but sometimes the past is not an accurate indicator of what the future might be.
And that's the disappointing bit about this market, right, Udayan? The very same sectors that did extremely well in the start of the year, like pharma and IT, are now starting to unravel quickly. So Infosys, for example, has lost 10% of its value this month. How did you read into that margin concern news flow, and how does one approach Infi now?
I wouldn't be too worried, Sonia, frankly, about Infosys. I know the margin warning has disappointed the market and the stock has adjusted quite quickly. But, having seen Infosys over the last 2 or 3 quarters, you are beginning to get a little bit more comfort about the management. They're telling you the right things at the right times. They're not hiding. It is work in progress, and they've made no bones about it. I was the biggest critic for Infosys under the previous management, but now things seem to be falling into a bit of a pattern. So, unless something terrible happens, Infosys seems to be on course to get close to 70 rupees earnings next year, FY17. It may be off a rupee or two here. 15 times 70 is 1,050, which is where the stock is right now. I think Infi is almost completely, perfectly, fairly valued at 15 times 2017 earnings. Given that they've themselves said that the next 6 months is not going to be great, I don't see how the stock should be trading at a much higher multiple from here. So I would say the mean point of Infosys now should be where it is now at around 1,050. Where the market is bad, the news from IT turns out to be bad, it can slip to say 14 times, lose a P multiple notch. That would be 980, 1,000 rupees. I think frankly 975,000 is floor for Infosys. If things improve and they spring a margin surprise, then you could go to 16 times, and that would be something like 1120, 1125. I see Nifty trapped, Infosys trapped in this 1,000, 1120 kind of a broad range till such time as they begin to see a pickup in margins and the business once again, which should have to wait for another 3 to 6 months at least. Is it going back to reclaim the highs it hit on result day of around 1200, 1225? I doubt it very much. There is no reason to do, given that the market knows that the current quarter or the next quarter is going to be weak, as the management themselves have said. I see it as a range-bound stock, but not a stock that one should panic about. I would be more worried about HCL Technologies. I don't know what's going on there because the last couple of quarters, this quarter particularly, very lackluster. You will remember that the two big guns of IT before Infosys came onto the scene a few quarters back was TCS and HCL Tech. TCS has had an average run of form, and HCL Tech is trading about 20% off its peak, and it's trading at the same P multiple as Infosys, by the way. So for serious IT investors, that's the question which I would ask, whether at 15 times, given the last 6 months performance and management commentary, are you better off buying Infosys, or are you better off buying HCL Tech? That's something Rima could chew on.
Okay, well, then let's get back to the market. We keep talking about how FI inflows have dried up this year, but I got a startling stat yesterday that the SIP investments are up 800% this year, or 8 times, and could be leading to a bit of an equity cult domestically. Do you think that could be a big trigger for the market once this whole, does settle down on Fed rate hike and all, and the market can make a big move based on that?
It already is, Anuj. I think without the numbers that you spoke about, this market would never have been standing at 7,700 or at the kind of valuations it's trading at today. Frankly, if the domestic flows were not there, I think this was a 6,900, 7,000 kind of a market. They have saved the market from going down another 10% at least, in my eyes, given the kind of earnings and FI flows that we have witnessed so far. So I think that's the biggest thing going for the market, and is the single most important reason why the market is repeatedly trying to find floors, 7,500, 7,700, where it could have easily tanked lower than that. So I think that's the biggest thing which has happened over the last 4 quarters, that domestic money has walked in and soaked up a lot of the pressure which has come in from the FIIs. But this assumes even greater importance, Anuj, in the light of how we see 2016, because 2016 could be a year either of Fed hiking rates and therefore emerging market investing going slightly out of fashion, which seems to be in vogue right now as well, because there is disenchantment with emerging market returns. In that context, will domestic money continue to insulate the market or help it to find higher floors? I think for 2016, this domestic money question is a very, very important one, and I hope we see as strong flows as we saw this year from the domestic mutual funds. That's point A. Point B is the last week or the last few days,
okay,
both FII...
Sorry, just hold on to that. Yeah, we'll resume in a second. We just want to tell our viewers about the market opening. It's absolutely flat. So 78.36 on the Nifty. The Sensex 2 is flat. The midcaps are showing a slight bit of traction, but not too much. And the Bank Nifty is slightly sluggish this morning, down about 0.3%. Quickly on to individual stocks. The Bosch is the biggest Nifty loser, down 2% as the US is now probing Bosch's knowledge in the Volkswagen scandal. So that's a stock to look at, 2.5% lower now.
I'll have to interrupt you just for 5 seconds. You have to point out Jindal Steel and Power. That really is the stock of the day right now. 15% higher on that. That's a stock that we mentioned in the morning as well. 14% higher on Jindal Steel and Power. Sorry, you're talking about Nifty stocks.
No, of course. JSPL, as we were telling our viewers, the competition watchdog has rejected all complaints against the company. The company was accused of cartelization. So now that the complaints are rejected, that stock is seeing a big fillip in trade. But we'll get back to the broader market stocks in a bit. From the Nifty, as I was mentioning, Bosch under a bit of pressure. Sun Pharma, Lupin continue to reel under a bit of pressure, so the pharmaceutical space is still sluggish there. ITC is down about 0.6%, and so are names like Idea Cellular and ONGC, both those names down about 0.5%. On the upside, because of the pay commission report, you have a lot of the consumer durables and auto stocks that are doing well today. For example, Hero MotoCorp, M&M, Tata Motors, Bajaj Auto are all higher by about 0.5 to 1%. GAIL is higher by 4% this morning, so that's a big move that you're seeing on GAIL today. And Dr. Reddy's, after cracking 25% in November, Dr. Reddy's is making a very measly attempt to rebound, so about 2% higher now on Dr. Reddy's. But Rima, the mid caps are showing a bit of traction this morning.
Yes, the Midcap index is higher by nearly 0.3%. The advanced decline ratio positive at 2 stocks in the green for 1 on the losing side. GSPL is clearly the biggest non-nifty mover today, now up close to about 14%. Apart from that, keep a eye on a few of these oil and gas names. So GAIL is the biggest gainer in the nifty, and in the broader markets, you've got Petronet LNG, which has rallied close to about 5%. Eros continues to stay locked in an upper circuit of nearly 5%. You've also got gains in a few of these consumer discretionary names like Voltas, so perhaps on the back of that 7th-pay commission. Keep your eye on sugar, another day when it's correcting. So Sri Renuka has lost nearly 1%, and a couple of these aviation names like Interglobe Aviation as well as Jet, which rallied hard yesterday, have paused and are giving up some of their gains. But that's broadly what's happening in the broader markets. But Udayan, coming back to you, on the sugar sector, or for instance, even textiles did fairly well. In the past, these trading rallies of 40-50% have failed to deceive. This time, you've got some positive news, at least fundamentally, for sugar. Do you think it changes the picture?
I'm afraid I'd have to say no, Rima, because I'm not a big fan of these sectors at all. There was a time a few years back when sugar came into vogue from a trading perspective, and people made a little bit of trading money. But sugar and paper sectors in the long term which have never created wealth for investors. So I would be very, very cautious. I know this 4.5 rupees a quintal and the financial package which is being worked out for farmers has got people excited. I would use it, frankly, if I ever owned sugar stocks, to see this as a great exit opportunity. These stocks were completely bombed out stocks. Nobody touched them for the last 1 year. And suddenly they've got 20-30% rallies going in them. I would run for the woods if I ever owned these stocks. I would just dump them at this opportunity and get out. It doesn't matter if they go on to rally 10-15% more. These are not great managements. This is not a great sector. It's heavily under policy influence and random and ad hoc policy influence from the governments. And I don't think any of these companies have high quality managements running them. And just to put it in perspective, Renuka has rallied 30%. It's trading at half its value, the peak value that it saw in 2014. So these were all on the verge of becoming penny stocks. Your eyes shouldn't light up at the first sign of some policy crumbs being thrown at them. I think it's a great exit opportunity, frankly. And if you manage to exit in this run, then I think you should make a promise to yourself that you should not buy stocks in the sugar sector ever again.
Yes, we all remember your comments from before as well, Udayan. That's very bluntly put. But the theme of the day seems to be this reaction to the 7th Pay Commission recommendations. Would you play any of the auto or consumer durable names? Because in the previous time, in 2008, when the 6th Pay Commission came out, there was a 10-20% growth that we saw in sales for the auto companies. This time around, how do you play the theme?
I think this is a double-edged sword. What the government is trying to do is clear, that they are finding it difficult to galvanize capex spending or turn the investment cycle as swiftly as it could. They are now throwing money at consumption. I think it's a clever thing to do. I hope they can manage the fisc also so that it does not run out of hand, because that's another way to look at it, what it does to the fisc and what it does to a lot of these public sector managements and how they deal with this kind of cost hikes. It may be absorbed in a larger public sector company which has very large manufacturing operations and where this ratio of wage bill to overall income is somewhat on the lower side, maybe 10, 12, 14%. But when you come to a technology kind of a company, the Engineers India kind of companies, where the wage bill relative to the income is quite high, then I think you're putting an unfair burden on some of these PSU stocks. So you need to be a bit careful about what you're buying in the PSU basket in the light of the proposed hike. To come to the other side, I think this certainly will give a fillip to consumption, and that's what the government is trying to do. But you spoke about autos. I think the place to look at in the auto space now, Sonia, would be some of these two-wheeler kind of stocks, because it's gone out of fashion. Hero Honda has said something not very positive. Bajaj Auto has been under pressure after the recent quarterly numbers. But I see this giving a little bit of a fillip to the two-wheeler sector, where valuations are not very high. In some of these stocks like Maruti, valuations already capture a lot of the good news, and the trade is somewhat crowded. I don't like crowded trades. So I think two-wheelers is a space where you might find some degree of traction coming in because valuations are quite reasonable, and of course some of the autos will do well. Consumer durables is another space you should look at very closely, and there's a fair degree of basket of stocks in the market which can benefit from this move quite directly. So I would actually put consumer durables ahead of autos if you want to play this consumer consumption boost theme which is coming in from the pay hikes. But to cut a long story short, this is certainly positive news from the consumption basket, and the government is probably doing the right thing if it can manage the fisc. It's trying to stoke consumption and breathe a little bit of life into growth which is not recovering at the pace which it wants it to.
Okay, by the way, just a word on the market again. The Midcap index is now at high point of the morning, so 0.5% higher on the Midcap index, and some of the stocks which are looking good, apart from Jindal Steel and Power, Petronet is up 4%. Eros International, a lot of news around that stock, that is up about 4%. And then you have a couple of stocks like Alok Industries, Gati, also doing well. Udayan, a lot of people would have promised themselves not to buy aviation after the slip from Jet Airways from the IPO price, the way Kingfisher went bust. I'm sure you're following what's happening with Indigo, 1100 now on that stock. Do you think it's a trade which is running way ahead of fundamentals, or the low floating stock itself can take the stock even higher from here on?
A bit of the latter, Anuj. I think there is a technical issue in Indigo as well. I'll make 2 points. One, of course, Indigo is a high-quality airline, no question about that. But I did go through the IPO numbers before they came out. And, you could argue both ways because I found it very difficult to try and predict Indigo's earnings with any degree of accuracy given the kind of elements which creep into the earnings stream. It's not a simple fly more passengers, make more profit kind of a model. There's a lot which goes into the reported earnings of Indigo, which makes it a fairly complicated structure to predict. It's one thing if you say, I want to buy big brands in India because I know in the long term they will make a lot of money for me. Fair enough. I want to buy the market leader in every sector and stay the course. If you approach Indigo from that kind of a mindset, that I'm buying a good business, reasonably good management, a market leader, and somebody who's just come out and in the last 10 years and blown the lights out in the aviation sector. That's a simplistic yet a reasonable way to look at Indigo as a stock. The moment you start getting into the nitty-gritty, then you begin to fret a little bit about how predictable or how easy it is to model and predict for a lay investor. So I don't know where the stock is going because there is scarcity premium out there. People want to own. If people want to own aviation, they want to own Indigo, and that I think is a completely fair way to be. What I will make this point, Anuj, is don't think of Indigo as a great pickup for the entire aviation space. I know all aviation stocks have done reasonably well in the light of Indigo, but there you could go wrong by saying if Indigo is going up, then all other stocks must go up because Indigo is picking up valuations for the entire space. I think the opposite might be true. Look at the way Indigo has eaten market share from pretty much every player over the last 5 years. So I think to say that when Indigo goes up, all aviation stocks might go up, I think it's a bit of a fallacy because its lunch is actually eaten from other people's plates. And I would be quite worried about buying into other aviation stocks just because of Indigo. Having said that, it needs to be said that the way crude has crumbled and the way ETF prices are coming off, I think that itself will give a lot of margin boost to some of these aviation companies. So don't buy the sector blindly. But the prospects of aviation as a space, certainly compared to the last couple of years, look much brighter.
All right, Udayan, we'll let you go. You have a good day, good weekend. We'll touch base with you again later. But thank you for your thoughts. That's the word coming in from Udayan Mukherjee. By the way, a couple of more stocks that do deserve mention. Sundaram Clayton, which was Mr. Tulsian's multi-bagger idea, is up almost about 10.5% right now. And Gujarat Gas and GAIL are both up about 5.5 to 6% odd.